Ya. Estamos transmitiendo también en vivo por nuestro canal de YouTube. Vamos a empezar entonces. A todos los que nos están viendo en este momento, quiero darles una cordial bienvenida a nuestra primera charla del ciclo de charlas Mirada Pacífico. Acá pueden ver a Enrico Vicentini, socio fundador de Pacífico Research, ya nuestro invitado, speaker de este webinar, Pedro Safí. No voy a introducirlos porque ellos mismos, Enrico se va a encargar de hacer la presentación de Pedro, así que voy a bajar mi cámara y mi micrófono. Y bueno, reitero las bienvenidas y estén atentos porque les vamos a seguir mandando invitaciones a futuras conversaciones.
Gracias, Francisca. Antes de presentar a nuestro invitado estelar, quisiera muy brevemente contar lo que hacemos en Pacífico Research. Pacífico es una empresa de research independiente que fundamos el año 2014 junto al macroeconomista Igal Maguenzo, con la idea de entregar un research independiente y altamente técnico a instituciones financieras. Hace algo menos de un mes incorporamos a un nuevo socio, Jacques Burrus, ingeniero financiero francés, formado en la École Polytechnique y en Berkeley, con el ánimo de profundizar nuestro conocimiento en finanzas cuantitativas y tecnología, que es en parte a lo que se llega a hacer cargo Jacques. Hoy día somos 6 analistas, además de los socios, cubriendo Colombia y México, perdón, Colombia y Chile, y en el corto plazo queremos incorporar también Perú y México a nuestro análisis. Nuestro objetivo principal es apoyar a nuestros clientes, en su mayoría inversionistas institucionales, en la generación de alfa mediante la comprensión del escenario macroeconómico y facilitando sus procesos con el uso de tecnología. Antes de continuar, quisiera mencionarles que esta conversación va a ser en inglés, a pedido de nuestro invitado. Así que de ahora en adelante voy a cambiar a inglés y lo voy a presentar también en inglés. So the idea of this webinar is to share with the LATAM financial community discussions around topics that we find interesting as empirical researchers, and one of those is short selling. That is why I wanted to welcome or invite you to join this conversation with Pedro, who is Pedro Safí, Dr. Pedro Safí, who is a reader in financial economics at the Cambridge Judge Business School, and he's also the academic director of the Master of Finance of the same school. Pedro holds a PhD in finance from the London Business School. Before joining Cambridge, he was an assistant professor of finance at IESE in Spain, so he also speaks Spanish. But still, he wanted to do this in English. Prior that, he graduated from Fundação Getúlio Vargas. Forgive my Portuguese. He's a Master of Science also in economics from IBMEC. Also, he graduated from the economics program. Pedro, his research focus is in short selling, security lending, and the limits of arbitrage. He regularly presents his work in top academic conferences and contributes with articles to the popular press. He has published his work in the top finance journals in the world, like the Journal of Finance, the Review of Financial Studies, Management Science, and the JFQA. In 2012, he was awarded one of the Q Group Researchers Award in 2013 and 2018, an award by Inquire Europe in 2015, the NAC and BlackRock Global Challenge for Innovation in Corporate Governance, and also the Pangora Asset Management Prize. In 2012 and 2015, he also was awarded as an outstanding teaching award by the Judge Business School. His professional experience include working as a consultant to Mondrian Investment Partners, as a corporate valuation expert for the United Nations Permanent Court of Arbitration, for real estate companies and for pharmaceutical companies. He also serves in the advisory board of a hedge fund that uses machine learning methods to trade cryptocurrencies. He also supports the Quant Society at Cambridge. And beyond quant finance, Pedro is an art enthusiast and food enthusiast. I'm sharing your secrets, Pedro. All of them topics that I personally enjoy while engaging in conversations with him at my own time at Cambridge. That is why I could not think of a better person to open this Mirada Pacífico webinar series. So let's get started. Pedro, would you kindly explain to our audience what is short selling? What are the implications to such operations for financial markets, and how do these operations also contribute to market efficiency?
Okay, so first of all, good afternoon, everyone. Thank you again, Enrico and Pacifico, for the invitation. So the plan for today is essentially, as Enrico was mentioning, to talk a little bit about short selling, what are the benefits, disadvantages, and a few interesting results that might be useful for everyone in the audience. So let me begin by showing you my first slide, just talking what is the main purpose of short selling. Essentially, short selling allows us to speculate on security prices going down. So even if you don't own shares in a company and you believe that their share price should go down, short selling is essentially what allows us to do it. Okay. Now, the next bullet point gives us the definition by the Security and Exchange Commissions in the US of what short selling actually is. Well, it is essentially selling a security that the seller does not own. And in order for the seller to deliver the securities to the buyer, the short seller will borrow the security, typically from a broker-dealer or a large institution investor, who are often things like pension funds, sovereign wealth funds, mutual funds, and so on. Okay, and the short selling is actually something that is in fact not new. The first recorded short sale took place almost 410 years ago. It was essentially this person in the Netherlands shorting, I believe, a stock there. And right now, last time I checked this, in the New York Stock Exchange, short selling accounts for almost 42% of trading volume. So on a given day, 42% of all trades involves a short seller out there. Okay, but maybe many of you have seen this. Short sellers tend to have a very bad reputation with both politicians and the public. Soon, maybe we can talk a little bit about the whole issue with GameStop and the battle between the short sellers and retail investors. But as you know, short selling really doesn't have a good reputation in terms of what especially politicians think. Okay, it's a different question what academics and most regulators think about short selling, but definitely it has lots of bad reputation from it. Now, when we look then at whether short selling is good or bad for markets and how it changes things, essentially we can divide those different effects into three major ones. One, of course, is our regulatory implications. I mean, does short selling helps market liquidity? And that's one of the first links to making markets more efficient. So if you have a bunch of people that want, for example, to buy a particular stock, if we allow short selling to take place, we're going to have someone on the other side of the trade allowing this to do so. And later on, I'm going to show you a couple of slides that, in fact, allow us to see that short selling essentially allows bid and ask spreads to be smaller. Essentially, it allows information to be more quickly incorporated into financial markets and so on. A big point of interest for regulators is whether short sellers manipulate markets. And here, in a way, it's a little bit like what happens even when people buy companies, right? In the same way that we can have some investors trying to manipulate stocks and pushing their prices up, I don't think anyone can deny that there could be some short sellers that try to create false information and false rumors to make share prices go down. But on average, some of the results I'll show you during the presentation hopefully will convince you that most of the time, short sellers do have a positive influence to financial markets relative to just being manipulators trying to make money by creating false information. Okay. Now, another big strain of investigations is, given the characteristics of the market for short selling, there are also some implications for how investors and institutions can vote. Okay, and I have a couple of papers that actually look at this, and overall, this is just a quick summary to tell you that this is a very active research topic, especially now, given what happened after the financial crisis and with GameStop. People are putting lots and lots of eyes on this whole situation. And it's definitely an important research subject to know that, on average, is short selling a good or a bad thing? Okay. Now, in terms of the benefits of short selling, definitely manipulating prices is a bad thing. Okay. And this is something that can happen either on the long or short sides of any trade. But if we think about it, we never see any CEO complaining that their stock price is too high because people are too optimistic. But we always see what? A bunch of CEOs complaining that their share price is too low, and maybe it's because of short sellers manipulating market. And this is essentially one of the main benefits of shorting, in which short sellers prevent some investors that might become too optimistic about a company from inflating prices. Okay, and essentially, I mean, think about the markets as aggregating the opinions of all different types of people, both optimists, pessimists, super excited, super pessimistic about the company. So if we live in a market in which regulators prevent people from bringing in their negative opinions, prices are only going to be set by the really optimistic investors, while the pessimistic ones would not be there. So in a way, it's just like if we think about politicians, right? If we don't allow the opposition to voice whatever they think, we are really not going to have any idea what these people that might be restricted from markets actually think. And often their opinions contain valuable information for all of them. And this is the meaning behind this price discovery, in which markets are continuously aggregating all types of information that different investors can bring to the table, either because they are doing their own fundamental research and they find out something bad about the company, or because they are constructing portfolios and trying to arbitrage price inefficiencies across securities, and so on. So my first academic paper was actually the main chapter of my PhD dissertation. In fact, looks at this. It actually shows that short selling improves market efficiency. Not only stocks tend to react more quickly to new information if investors are allowed to short, we in fact also show with something that might be a somewhat surprising result, which is that stocks that are more easier to short, they tend to be less volatile and also to have lower levels of downside risk. Okay, and finally, allowing short selling does not increase the probability that we're going to observe extreme negative returns. And the analogy that I usually do in these cases is just like probably that old story that I'm sure all of us heard about a city that has this big hydropower dam, and the dam has a hole in it where water is leaking. Okay, and essentially we try to prevent the leak by putting a finger on it while the whole thing is coming. In a way, if we try to prevent short selling from taking place, it's almost like we're going to have all this negative information being prevented from coming and being released into the markets. And when it does, so when the dam busts and all the water comes in, that's when we observe what? Really big negative shocks. And if we allow short selling to take place, that's the idea behind this incorporation of new information. Now, as I move on, let me talk a little bit now about the bad reputation that short selling has among non-academics, and especially among politicians and so on. So Almost 200 years ago in France, Napoleon actually decreed a 1-year jail sentence for anyone caught short selling. In the 1992, when there was this whole battle between the Bank of England trying to defend the pound, when George Soros made a lot of money, the finance minister of France said that during the revolution, such people, so the short sellers, were known as agitateurs and they were beheaded. In 95, the Malaysian finance ministry during the Asian crisis proposed mandatory caning, so should be beaten up as the punishment for short sellers, but he said that the beating should be light, similar to the punishment that we give to teenagers. My favorite story is actually this one here from the Archbishop of York, who is a big a cardinal of the Church of England here in the UK. And he was talking around the financial crisis that to someone like him, those who made 200 million pounds short selling the shares of HBOS, which is this big bank here, they're clearly bank robbers and asset strippers. The interesting thing is, after he said that, one of the newspapers here in the UK looked at the investments of the portfolio of the endowment of the Church of England, and they found out that the church actually made lots of money by short selling bank shares around the financial crisis. So the last one here is a comment by Elon Musk. I mean, we all know Elon Musk is in all conversations in finance at one point or the other. And he is a CEO that is particularly against short sellers. And he actually tweeted in 2017 something like, short sellers are jerks who want us to die. They're constantly trying to make up false rumors and amplify any negative ones. So as you can see, I mean, this just gives you a little flavor of how against them company CEOs and I guess the general public can be about short selling. Today I won't have time to show you, but if you are interested, maybe I'll open this and post it here on the chat. So this link here is a very, very interesting video from the former CEO of Lehman Brothers, so Dick Fold, in which he said that he hated short sellers so much that if he could, he would rip their hearts out and eat it, okay? And that's kind of the background that often we see the discussion about short selling taking place. Now, the next thing that I want to show to you is essentially, well, the whole market behind short selling. So this can be seen as like the plumbing that takes place whenever we have a buyer buying shares from a short seller. Okay, so if we start here by on the right, suppose that we have a hedge fund that is trying to short shares on GameStop. Let's use GameStop's example. Okay, well, in order to sell short this share, the hedge fund needs to borrow these securities from someone. So on the left, those are our beneficial owners, which are typically the institutional investors that owns the shares, okay? So between the fund that is trying to sell short and the institutional investors that own the shares, we have a bunch of financial intermediaries that act as the middle person in here. So we have the lending agents. So they're the ones that typically have the mandate from the institutions to lend their securities. So big institutions like State Street, Fidelity, and so on, they essentially aggregate holdings from all of these institutional investors and they lend them to the potential borrowers. Okay. Now, helping the hedge funds, the ultimate short sellers, we usually have what? The big broker dealers. So if a hedge fund wanted to short GameStop, the broker dealer would try to locate the securities from the lending agents. Now, typically the beneficial owners like lending securities because they provide an extra source of income to lenders. And the vast majority of investors lending this tends to be institutions. As I said, the big pension funds, mutual funds, sovereign wealth funds, they're the ones that typically are investing for the long run, and they just buy securities and would sit on top of them and have securities in their portfolios. So an additional way for them to make money is by lending them to the short sellers. Now, let me show you a couple of graphs on that. So this here shows the annual revenues from lending securities all over the world in the past 10 years. Okay, so the source of this data comes from a market. And that's kind of the data that I have used in almost all of my papers. So just to give you an idea, in 2010, there were about $9 billion in global securities revenues, okay? Most of it comes from lending shares. Some of it comes by lending government debt, and just a little bit from corporates. Often when we look at people borrowing government debt, this has nothing to do with shorting for speculative purposes. We actually have something that in which is something that we call collateral transformation. Sometimes we're going to have a hedge fund borrowing those sovereign government bonds and using those government bonds as collateral to lever up their positions. Okay, and this is just a way to increase the proportion of debt in your investments, which comes with the usual risks and opportunities. Now, an interesting thing also that I want to show to you is that this is the snapshot for 2020. Okay, so notice that we can pretty much nowadays borrow to short every single security we can think of, whether it's the American depository receipts or the exchange traded funds. Notice that because the US market is so big, we have lots and lots of activity there. But what I wanted to actually show you is that is a couple of things. One, that the typical fee to short tends to be very, very tiny. Okay, now where does this fee comes from? That makes me go back to the whole mechanic of this. So for example, if we have our hedge fund borrowing the securities, it's almost like we are renting the shares from someone else. So if suppose, for example, that Enrico is lending me shares in GameStop, in exchange for Enrico giving me the shares, I'm going to pay him a fee, so a rent, and any dividends that the company pays to the short seller, I also by contract give it back to Enrico. Okay. Now, in exchange, on top of the fee, I also need to put some collateral. And typically in the US and here in Europe, this collateral amounts to about 102% of the value of the loan, so of the short selling position. A very interesting thing that happens also is that if Enrico lends to me his securities, he also gives to me the voting rights. So essentially, if you think from an institutional investor point of view, when they lend securities, even though they get this income by renting the securities to the short seller, they also give up the voting rights. So there's this trade-off that is inherent with short selling and someone that's lending securities, in which we choose to either lend and make a little bit of money, or we have the voting rights if the situation arises, which is something that later on I'm also going to show to you. But going back here to the summary statistics, notice that typically to borrow shares to short tends to be very, very cheap. So this average fee here is actually annualized. So just to give you an idea, if we take a look, say at, well, we can look at Americas as a whole. If you want, say, to borrow the typical stock in America, so this includes all of South America, Canada, Mexico, the US, and so on, we would typically pay 0.8% a year. Okay, so 80 basis points, which is very, very tiny. However, what happens is, depending on the company, if the market is really pessimistic about it, then these fees can in fact increase a lot. So if we take again the example of GameStop, if you look at the lending fees at the end of January, because of the constraints that took place there, the borrowing fee for renting shares in GameStop were around 200% a year, okay, which were super expensive. And this is related to what? Back to this market here. So essentially what happened during the GameStop situation is that lots and lots of hedge funds had shorted the stock. And when the share price started to go up a lot, remember that the maximum profit that a short seller can make is if the stock price goes down to zero, right? You cannot go below that. However, the potential downside is what? Illimited, right? Because the market can keep going up and the short seller essentially has an unlimited downside because of this. So with GameStop, what actually happened is, because of the whole increase in prices, as those retail investors were buying shares, There was also a lot that was going on because many retail investors were buying options, and then the banks that were selling these options had to hedge their exposure by buying shares in GameStop. But all of this essentially started facing many hedge funds with big losses. Now, at first, many of those hedge funds were just shorting because they believed that the increase in the price of GameStop was crazy and they would go down. Now, what happened in this case is that after they shorted, essentially later on, they had to return the securities to the ultimate lenders. And with prices going up, lots and lots of retail investors were just keeping the securities. The banks, because they were hedging the options and their exposure, they also kept the shares with them. And suddenly, the supply available of shares in GameStop started to go down. And that's when the panic really ensued. And that's what we call this short squeeze. Essentially, short sellers could no longer easily find securities to return to these ultimate owners in here. And that's when the price started to go up. People started getting desperate because they had to return the securities, and it was very difficult to locate them. Okay? Now,
Pedro, can I ask you a question here? Thinking about the GameStop Reddit case and what you were mentioning about the short squeeze, do you think that this kind of trades should be limited to institutional investors? I mean, pure short selling, or could it be maybe a midway where you could also express your view on a stock in a different way so it doesn't harm the market like it did in this case?
So, just like Warren Buffett said that derivatives are a weapon of mass destruction, okay? I think short selling is something that only, say, qualified investors, I think, should do. One, because the downside risk is unlimited, right? And so people really need to be aware of where they're putting their money. Okay, so in theory, just like any derivatives, in a way, short selling allows us to just make a bet that the share price of a company is going to go down. So intrinsically, there isn't much different than we just having an opinion that the share price will go up. So one way that we already have in place making short selling more difficult is that the margin requirements are what? Higher, right? So in a way, it's saying, okay, if you want to short sell, it's fine, but then you need to set aside a lot of capital to cover a significant chunk of losses if they occur. Okay, so in my opinion, there are already ways in which markets and regulators try to make short selling more difficult simply because it's more complicated with more potential risks. So this is a bigger discussion in terms of, especially if we're talking about retail investors, which maybe is your the idea behind your question, which is what should we allow retail investors to trade? Should they be allowed to trade everything regardless of the risk? Yes or no? So in Brazil, for example, our securities regulators, so la Comisión de Valores Mobiliarios de Brasil, they are usually very, very careful with financial products impact on retail investors, whether it's structured notes, derivatives, and so on, exactly because of this, right? Because unfortunately, we know that many people, they get greedy. Just think about GameStop, and they think that they can make an easy money. Just like in GameStop, there were some people that bought shares when they were at 300 that ended up losing lots and lots of money, which had nothing to do with short selling. It was really people maybe taking bets that were much bigger than they could swallow, which could bring big losses for people that are not aware of them. Okay? Now, the next thing that I want to show to you is just how people actually measure short selling, right? So all this data that I'm showing to you and so on, what do people do? So in this slide, and I'm not going to focus a lot, is just provides a small taxonomy, so of short selling data all over the world. Traditionally, people had access to what we call short interest, which is essentially what? The short positions across a particular stock exchange divided by the market capitalization. So essentially, what is the fraction of the company at some point in time that's being shorted? So this here, even though it's been available for a long, long time, it was only released about twice every month. Okay. Now, in 2004, we also started receiving much more high-frequency data coming from the order flow. So essentially, in the New York Stock Exchange, they had a flag that would allow us to know whether in a particular trade we had a short seller or not. So in this one, we would be able to know how many trades involved a short seller, and further than that, also be able to break down what was the type of investor doing the short selling, whether it was the retail investors or institutionals, or institutional investors, or the proprietary trading desks, and so on. The data that I have shown to you, which is the one that I use on my research, comes from the securities lending market. And in this one, we have every single day since 2006 information on how many loans are in place on a given day, so how much people have borrowed. And usually what people have borrowed is a good indication of what they have shorted. We also have the fee that people have paid. So it gives us an idea of the demand for shorting, so how much people dislike a particular share. And even though this has daily data, we still don't have individual investors. So we have no idea of who's shorting. Well, since 2012, here in Europe, any large short position above 0.5% of the market capitalization has to be disclosed to the public on the following day. So for the first time ever, we actually know exactly who are the big shorts that are targeting a particular company. Okay. Now, I don't know if I'll have time in the presentation, but I'm actually using this data to do a research that tries to look at what happens when we have hedge fund activists and the big short sellers in the same company, right? If we think about it, just like short sellers are supposedly smart, sophisticated investors, hedge fund activists are also the same, right? We're usually big and famous people like Bill Ackman, Carl Icahn, and so on, that they think that they look at a company and they say, think about GameStop. A hedge fund activist might look at GameStop and say, well, the company now is not doing so well, but I think that we can turn things around and make it better. A short seller looks at GameStop and say, well, I think that this company is doing poorly and it's only going to get worse. So we have this battle between people with very, very different opinions about a particular company. And then in this research, we actually see what happens, right? I mean, can hedge fund activists make more or less money if they know that there's a big short seller targeting the stock? Do they attract each other? I mean, maybe if I see, for instance, Enrico hating a particular stock, it might make me pay more attention to its fundamentals, and maybe I can become an activist to try to make the company better, and so on. Okay. Now, the next one is just a picture to give you an idea about the overall activity in the US. Okay. So this measure here of on loan is the one that I was telling you, which is the fraction of the company's market capitalization that is being borrowed at a certain point in time. Okay. Now, the black line here is the average from 2006 until 2013. Now, notice that here I mark two different points. One is the quant crisis, when we have lots and lots of quant funds losing lots of money around 2007. But more importantly, what happens right after the bankruptcy of Lehman Brothers, when we had the big stock market crashes. So notice that on average in the US, we have about 7 or 8%, or maybe 4 or 5% of the market capitalization being shorted in this period. Notice that right after Lehman Brothers and the stock market crash, notice how short selling went down on average, and even more so for stocks that were really, really being shorted. And what can explain this? Well, one is just simple profit taking, right? Because markets went down by 40%, we essentially had what? Lots and lots of short sellers that said, great, we made lots and lots of money. So now let's realize our profits and close our shorts and go home and be happy about it. I'm sure that most of you watching us today have watched that Big Short movie. And in there, what were they shorting? So those funds were shorting the mortgage-backed securities because they thought that the value of all of those mortgages and the real estate in the US was what? Worth a lot less. So essentially, they shorted before the crisis. After the whole market came crashing down, the value went down. And what does the short seller do? Buys the securities at a very low price and returns it to the original lender and pockets the difference between the point we shorted and the point we closed the deal. Now, I think I'm going to skip this slide. I was just trying to show how academics measure abnormal performance, simply because now I'm going to show you what is the evidence on short sellers making money or not. Okay. Now, before we can say anything about people making money, we need and generating abnormal returns, or the alpha that, again, I'm sure everyone here knows about. Before we can define something that is abnormal, we need to first know what normal is in the first place. So what is our benchmark returns? Okay. And as you know, I mean, we have lots and lots of different risk factors. We can use the traditional CAPM with the beta relative to the market. We can think about the Fama-French factor, so things like size, value, or quality, and so on. But the idea then is that we define abnormal as the difference between the actual return of a stock relative to what we expect. And if we're thinking about, for example, what a good mutual fund manager should deliver to its clients is what? Positive alpha, essentially delivering abnormal returns. So when we think about short selling, what is the strategy that we can test that would tell us that short sellers are actually smart investors that make money? Well, the idea is that we're going to short stocks that are in high short selling demand. So we're going to look at stocks that are being heavily shorted by the market, and we are going to sell them. And we're also going to buy stocks with low short selling intensity. Okay. Now, the main result that academics have found is that there is a big negative relationship between short selling intensity and future returns, which is kind of what this graph here shows. So in orange, we look at the monthly returns of stocks that are being lightly shorted today. So almost no one is shorting. And you can see that if we compute their abnormal returns over time, they tend to be positive. Okay. And after 6 months, this comes at about 3%, which annualized is what? 6% a year. So if we buy stocks with little short selling, they outperform the expectations by about 6%. Now, if we look at the stocks that everyone is heavily shorting, so this blue here, notice that after 6 months, they go down by -6. So the difference between red and blue is about 9%, which shows that the alpha in annualized terms of this strategy is about 18%. Remember that I just showed you that borrowing shares to short also costs money, that fee that I mentioned before. So we need to, in order to know the actual return to an investor of this strategy, we need to take into account the transaction costs. So even though on average shorting is very cheap, for the stocks that are really being shorted by the market, like GameStop, when I mentioned it earlier, they tend to be much more expensive to borrow. So even when we take into account these transaction costs, the alphas associated with the short selling strategy comes at about 6 to 7% a year, which is pretty good. Now, another interesting thing is, okay, if we do this short, let's try to understand where is this performance coming from? Is this because the good stocks that no one wants to short outperform? Is this coming from the bad stocks that everyone dislikes that will keep going down? And this graph here shows that it's a combination of both. Both the stocks that no one wants to short go up, but the ones that everyone wants to short go down. Now, there's a very interesting paper that had access to that data that allowed us to classify who was doing the shorts. Okay, so notice here that if we look at stocks that were being shorted the most, for example, by institutional investors, they're the ones that went down the most. So institutions are making money, proprietary trading desks are making money. Notice that on average, short sellers do make money, but the only people that in fact lose money short selling are individuals, which goes back to Enrico's question before. So essentially, this is just saying that if we look at the short selling trades of individuals in the New York Stock Exchange, we actually see that over 60 days, so this is about what, three calendar months, notice that the cumulative alpha is about 0.5%, which again is not a lot, but is definitely not positive. So essentially, they are losing money by doing so. Now, if we start thinking about crisis periods, that goes back a little bit to the story about GameStop, but even more generally, what happens when short sellers, or with short sellers strategies, when stock markets crash? Okay, so this is a paper that I have that started exactly because we're trying to identify when do short sellers make money. Do they make a little bit every single month, or do they really make money when we have big stock market crashes? Okay, now the results that we actually found were so surprising that the first time I found them, I thought that I had made a mistake in my code. Okay, so what we actually find is that on average, as we saw, if we look at stocks with lots of short selling, we do forecast negative returns. Okay, and there's nothing new here. The alphas before transaction costs are super, super large. But what we found is that whenever we had big crisis days, rather than the returns of the highly shorted stocks being really negative when the stock market was crashing, we actually found that for stocks that people were shorting a lot, their returns actually went up. Okay, so as I said, when I found this result, I said, well, I made a mistake. So I spent 2 weeks of my life going over my code to try to see what I got it wrong, but I couldn't. And that's when I said, well, how can we explain this? Well, this here is associated with what we call deleveraging risk. During times of crisis, we know that many investors might be forced to close their positions, both on the long or on the short side. And this could come from a bunch of different things. Maybe our clients are asking for their money back and we are forced to close our positions, both long and short. Or maybe our prime brokers might come to me and say, well, Pedro, I'm sorry, markets are too risky. So either you need to deposit more margins to keep trading, or else you have to deleverage. Or it could just be because managers look at an increasing risk all at the same time, and they decide to start what? Covering their positions. So we essentially found that during those periods of illiquidity shocks, especially related to how investment funds can fund themselves, rather than short selling giving you money, so future returns are negative, they actually go up. So, for example, let me show you this graph here. So on the left, this is what happened during the Lehman Brothers crisis. So during periods without anything weird going on, notice that this black line here is a little bit negative, okay? And that's kind of the 10 basis points every day. However, in the period around the Lehman Brothers crisis, notice that the more short selling a particular stock had, the more positive the returns were. So suppose, for example, that if you were a hedge fund shorting, say, the top 10% of shares, on that day, your portfolio would have fallen without any leverage by about, say, if I use the extreme case, 4%. If you are the typical hedge fund that uses 300% leverage, you could have lost 12% on a single day, even though during a normal period of time, you would be making money. Okay, so in a way, this provides another explanation on the reason for which, on average, short sellers make money. This is just compensation for what? For tail risk, for the fact that sometimes we can have these big events that will make short sellers lose a lot of money. Okay. Now, the last thing that I want to show to you, because, and again, Enrico, tell me if I'm running short on time. I mean, I have a bunch of interesting things to keep showing you, but at some point, maybe people would like to ask questions. The last thing that I want to show to you is an analysis of what happens with market liquidity. So there's a very, very cool paper by Beber and Pagano, and Alessandro Beber is now working for BlackRock, in which they analyzed all the different short selling bans and constraints that were put in place back in 2008. So we have lots of countries that forbade some stocks from being shorted. Some countries forbid only financial stocks and so on. So essentially what they did is they looked at stocks that were subject to bans before and after the ban was in place, relative to control stocks that were similar in terms of size, returns, and so on, but which weren't subject to these stock bans. And then they computed the bid and ask spread difference between them. So notice that before the bans were in place, essentially, the relationship was pretty much stable. So stocks subject to bans were a little bit what? Cheaper to trade. So they had a little bit less negative, control stocks were a little bit cheaper. But notice that immediately after the ban, suddenly the stocks that were now subject to bans of short selling, so people could no longer short them, became what? More expensive to trade, which goes back to that idea of market efficiency. Allowing short selling to take place is actually something good for markets because it allows liquidity to increase and people that want to buy can more easily find a seller, and that improves price efficiency and so on. Now, this paper here also shows that short sellers are good at identifying companies that are cooking their books, that are essentially engaged in dodging accounting misconducts. So this graph here shows the amount of short selling, okay, around periods in which the SEC starts investigating a company for accounting problems. So what this graph is showing is that short sellers start to sell the company almost a year and a half before the market is told about the investigations. So it does seem that short sellers are doing the Sherlock Holmes work of trying to look at the accounting information, the financial statements, and identify some companies that maybe are giving information to the market that is not actually true. So those investors like Carsten Block, which manages this very famous activist short seller fund called Muddy Waters, or Gotham Capital, that's exactly what they do. Okay, so they essentially try to identify companies that have a discrepancy between what they're telling the market and what their financial statements do, and they start to short it. Okay, now I think the last thing that I was going to tell, that I'm going to show you, and maybe Enrico, then I can shut up and we can have finally some times for a Q&A, is related to using short selling to try to understand a little bit more how institutions vote. So a big topic of discussion, especially in the past 10 years, when we start caring a lot more about corporate governance and ESG and so on, is whether institutions are really doing what is right for their underlying investors, right? I mean, think about one of the big pension funds in Chile or in Brazil or in the US. I mean, remember that they collect our money and invest in companies. And a big question is, when there is a big corporate vote, do they do what is right? I mean, do they really vote in ways that improve governance or allows the company to do what's best for shareholders rather relative to only what's best for management and so on? And using equity lending actually allow us to take a look at this. If you remember at the beginning, I told you that when the borrower gets the shares, it pays a fee to the lender, but also on top of getting the shares, they also get the voting rights. So essentially we have this trade-off that a lender has between making money or voting. Okay. Now, what we find is that institutions don't tend to ask back all of their shares to vote before the record date for a shareholder meeting, right? So suppose, for example, that if we have, I don't know, a big shareholder meeting of Alcan, before we have the vote, there is a certain date here in which we're going to see who are the shareholders registered. And those are the people allowed to vote. So if I have an institution or a pension fund lending my shares, I need to have asked back for the shares by the time of this record date, such that we can vote. So what we found is that on average, before the record date, we see that the supply of shares available to lend tends to go down. Okay, it goes down by about 10% of their average. So just this result is consistent with what? With investors acting responsibly. Because most of the lenders are institutions, this result shows that at least they care enough to ask back for the shares that they have lent to the shareholders, such that they can vote. The final slide I'm going to show to you is essentially this. Once we try to look at the difference in how many shares they're asking back, depending on companies that have more block holders or pension funds and so on, what we find is that, for example, companies that have larger shareholders, so the big block holders, they're the ones that tend to recall their loans even more. And all of these signs here, I mean, the same thing happens, for instance, for pension funds, are consistent with this idea that they care enough about voting that they agree to lose some money just to get these shares back. Now, just to give you an idea, there is a big, one of the largest pension funds in the world is the one from California, so CalPERS, okay? So essentially, CalPERS, they do have a securities lending policy. What they do is that there are some companies that they have a list of some companies in which they never lend. Those are the ones that they say, I always want to be able to exercise my voting rights and make my opinion be known. There are some of them that they just lend, and there are some of them that they monitor, and they do this on a case-by-case basis. Just to give you an idea how one of those funds can make money. So this web page here is essentially a report from CalPERS, but from 2015, when they were just giving some basic information about their securities lending. So there are two things that I want to report to you. So during 2015, their securities lending program generated almost $85 million in revenues. And since they started lending securities in 1988, they generate almost 1.4 billion. Again, I mean, CalPERS is one of the biggest funds in the world. I think that right now they have almost $350 billion in assets under management. But so relative to their returns, this amounts to about 4 basis points a year. It's not huge, but I think everyone here will agree that $100 million a year is what? A decent amount of money, right? It can pay, I'm sure, for all of the research and all of the data set and most of the infrastructure of the pension fund just by lending securities. So because in the past 20 years, short selling has become more and more relevant, I mean, the volume of short selling has increased, securities lending has also become a very important source of revenue, not only for pension funds, but also for passive investors. If we think about ETFs and index funds, remember that the competition between passive investments is not really about performance. It's simply competition in terms of what? Fees. Whomever has the lowest, right? I mean, I don't care if I invest my money with Fidelity, Vanguard, or BlackRock. If I want to invest in a fund that only tracks the S&P 500, what I'm really looking for is what? For the cheapest possible one. So securities lending actually allows passive funds to do what? To lower their management fees because they are making some money through securities lending, which is another way in which short selling actually helps investors after all, because it does allow the fees that passive funds charge to be cheaper. Okay, so let me finish now. Hopefully that was an interesting enough introduction to short selling. And maybe, I don't know if Enrico wants to moderate, pero y yo puedo decir a todos, si quieren hacer las preguntas en castellano, no hay problema. Desafortunadamente prefiero responderlas en inglés, pero no hay ningún problema si me las preguntan en castellano.
Sí, Pedro. Bueno, no sé si hay gente que está escuchando que quiera hacer alguna pregunta, aprovechar los últimos minutos. Yo tengo algunas, pero si es que hay alguien de la gente que está escuchando que quisiera hacer alguna pregunta, preferiría dar la palabra. Si no, a mí me gustaría preguntarte, Pedro, o sea, dada tu presentación y lo que mencionaste sobre los votos, me recuerda también el research de Ogusan Caracas de Cambridge también, sobre la forma de, ¿no es cierto?, capturar el precio del derecho a voto en la Junta. Y me lleva a pensar las implicancias en términos de la información que revela el hecho de permitir el short selling. Entonces, si pudieras comentar un poco sobre la información que se esconde, o si es que esta información o el permitir la venta corta nos ayuda a revelar cierta información que de otra forma no sería revelada.
Vale. So, yes, remember that the idea is that a short seller is someone that intrinsically thinks that the price of the company is bigger than it should be. Right? So in a way, that's an investor that either has some negative information about the company that they are trying to profit by shorting the company. Okay, so if we put constraints on short selling, we're essentially preventing people that have pessimistic information or they have negative information about the company from bringing their information more easily, right? Because in a way, I mean, if I'm a shareholder and I think that the share price will go down, I can just sell, right? But everyone that also thinks that the company is going to go down, that is not a short seller, may also want to short. So if short selling is in place, it becomes much slower that this negative information is going to be revealed. So the idea behind regulators allowing short selling to take place is exactly to allow information to come, whether it's positive or negative. And that's why I go back to what I had mentioned in the beginning, which is the idea that if we don't allow people with negative opinions to trade, prices are only going to be set up by the optimistic ones, right? And in a way, I mean, and we can make the link with politics all over the world. If we only allow people say that are happy with the government to voice their opinions, we might not know about the deep problems that might be hiding there. And sometimes these problems will just show up. And with short selling, it's exactly the same.
And would you say that also short selling kind of gives, for example, CEOs more accountability?
Yeah,
for
sure.
That might be the reason for Elon Musk tweeting that way, right?
For sure. And for instance, that a bank that has lent money to a company will keep monitoring to see if the company is doing okay, it will be able to repay the debt and so on. With short sellers is the same, right? Because CEOs will know that if they mess up and either invest inefficiently or maybe, okay, they use shareholders' money for things that are not really creating value, short sellers will come and what? And pounce, right? I mean, they might say, well, this company with these CEOs is worth much less than it is. And that's exactly the reason why most CEOs, they hate short sellers, because at the end of the day, we also know that most CEOs' compensation comes from what? From stock options or from bonuses, right? So if you have the short sellers there in your company, they usually are going to make your prices what? Lower than they should be. Especially for companies that are overvalued, short sellers will try to bring the price down. And if share prices go down, CEOs hate the fact that they're probably going to make less money in salaries than without them. And no wonder they dislike the short sellers so much.
So I think we are running out of time now. We are a bit over 5 minutes. There is one question that I would like to take from the audience, and this would be the last one before we close. Is the activist short selling, where you publish a research supporting your decision, a way to unveil potential real information about companies? How control is with respect to potential conflicts of interest?
So Miguel, good question. And notice that this happens both on the long and the short side, right? So think about how any activist investor wants to make money. So first, for example, let's think about, forget short selling, just think about the typical hedge fund activist. We're going to buy the shares, and then we're going to tell the world why we think that the shares are worth a lot, right? Maybe we buy the shares before anyone knows, and then we start saying that the company needs to change their operations, their strategies, their capital structure, and so on. With the short sellers, it's the same, right? I mean, first they short, and then they produce, as you said, the research supporting their decision, trying to convince people that the company's accounts don't justify the prices and so on. So in both sides, you are right, there are potential what? Conflicts of interest, right? I mean, essentially, people are expressing an opinion, hopefully based on facts. Now, if the question is, do people lie? They do, right? I mean, we all know that from life in them. And that's why, I mean, I said at the beginning, we are going to have people trying to manipulate the markets, whether they are shorting or buying, right? And if people are really creating fake news, as Donald Trump would say, about a company, then what can the company do? They can actually sue the investors and go to court. And that's what many companies do with the short sellers, right? I mean, we never see companies suing an activist investor that says that the company is too cheap, because they, of course, love prices to go down. But definitely, yes, the conflict of interest is there. What is important for other investors looking at this research is whether this is what? Supported by real facts or not, or whether it's not just manipulated, right? So just like anything in life, just because someone publishes a paper showing that a company is bad or a market is good, everyone is going to buy or sell it, right? We need to do our own homework and make sure that we do it. I think Sebastian, Enrico also had a question about whether there are some situations in which restricting short selling makes sense. Now, I think there are. One of them is when we're talking about financial stocks, or think about banks, right? Because the share price of a bank has such a big impact on the capital ratios, right? I mean, the problem is that if we think that the leverage of a bank is too high, many investors might start questioning whether that bank is solvent or not. Okay, and that was actually the reason behind, in 2008, when many countries, the US, the UK, and Spain, they put in place short selling restrictions on financial institutions, simply to try to prevent this panic from taking place. Okay, now overall, even if we think about GameStop more recently or throughout the crisis, at the end of the day, if a particular company really has negative information, it's probably worse to try to prevent this information from coming to the market and share prices to go down, pushing the problem ahead until the decrease is going to be much larger. And that's one of the things really that I guess makes politicians and most people in the public to dislike short selling, which is this idea that someone shorting is destroying the company. The problem here is that some companies, they are really overvalued. And what is the problem with this? Well, we can have lots and lots of, say, people that they're saving for their retirement, buying stocks at a much bigger value than they're actually worth. So usually when the information is truly revealed, we're going to have lots of people. And as we know, usually retail investors, they're the ones that lose the most during crisis. That if we had allowed short sellers to be there in the first place, we could have prevented this overvaluation from even starting altogether. So my academic opinion about this is that most of the times restricting short selling is not worth it. Okay. Now, after the financial crisis, there was like an interview with the SEC commissioner. Okay, and they were asking him, well, now looking back, did it help to forbid short selling when Lehman Brothers was crashing and so on? And his answer was, in the end, no, because basically we didn't prevent markets crashing, and we only made market liquidity to be worse. One of the reasons why we had the crash in 2008 is that lots and lots of companies were what? Just overvalued. So their prices really had to come down. Okay? ¿Qué más?
Okay, I think it's time to close, Pedro. I want to, in the name of Pacífico Research, give you a big thank, and we will see each other probably soon back in London and Cambridge if I'm able to come back. I'm catching my plane today, and I should be there in like 20 more days, ready to go after my quarantine. So I hope I see you in London in a few days.
Muy bien, pues Enrico, muchísimas gracias. Gracias a todos que están aquí conmigo hoy. Ojalá haya sido interesante y para todos ahí, buenas tardes, buenas noches.
Muchas gracias a ti, Pedro.
Muchas gracias, Pedro. También en nombre de Pacífico, agradecerle a Pedro y a todos quienes estuvieron hoy día con nosotros. Quienes quieran la presentación me la pueden pedir. Todos tienen mi correo, se los voy a dejar igual acá en el chat y se las podemos hacer llegar también. Ahí antes de bajar ahí les dejé mi correo electrónico para que me puedan pedir la presentación